a study on the incorporation of green fintech into sustainable investing to explore corporate practices in energy conservation and carbon reduction.
First, let's look at the table of contents. 1. Introduction. 2. Motivation. 3. Preparatory techniques and methodology. 4. Method flow and time management. 5. Expected results and contributions. 6. Work manpower allocation.
Finance and the environment are interconnected. What we do in one sphere has consequences in the other. Sustainable practices are not just good for the planet, they are good for business. First of all, what is green fintech? Green fintech is the combination of financial technology, fintech, solutions, and environmental sustainability goals. The concept uses innovative financial technologies to manage environmental challenges and promote sustainable practices in the financial sector. Second, what does sustainable investing refer to? Sustainable investing balances traditional investing with environmental, social, and governance-related ESG insights to improve long-term outcomes. In many ways, sustainable investing can be seen as part of the evolution of investing. Third, what is the main idea behind the corporate practices in energy conservation and carbon reduction? Corporate practices in energy conservation and carbon reduction aim to minimize environmental impact by reducing energy consumption and greenhouse gas emissions through efficient and sustainable strategies and technologies. Next, let's move on to the motivation part. The aim of this research project is to study the integration of green financial technology into sustainable finance, focusing on corporate green identity certification, bank loan contracts, and corporate energy saving and carbon reduction behaviors. In recent years, natural disasters from global climate change have drawn significant attention to climate issues. Green swan events triggered by climate change threaten financial stability, price stability, and economic growth due to their uncertainty. The transition to greener practices may cause systemic financial crises as energy, mineral, and metal prices potentially rise. Climate risks could also impact the financial system's balance sheets, affecting the execution and effectiveness of monetary policy. According to data from international research institutions, the total economic losses from extreme weather events from 2011 to 2020 reached $2.48 trillion. The push for energy conservation and carbon reduction has made sustainable finance a key global trend. Financial institutions and regulators are enhancing efforts to maximize the sector's impact on achieving net zero emissions. Green finance refers to financial products and services designed to promote environmentally friendly activities and sustainable development. It encompasses various financial instruments, such as deposits, loans, bonds, investments, and insurance, that support initiatives aimed at environmental conservation, resource efficiency, and ecological development. CSR is a broad sustainability concept, with ESG as its practice principle. The SDGs outline 17 specific sustainability goals. Companies increasingly focus on SDGs to improve loan contract conditions.
To continue this video, we are going to describe the preparatory techniques and methodology used in this project. This project leverages financial technology such as text mining, web crawling, to collect corporate news and sustainability reports, and combines this with international indicators and corporate disclosure information for industry comparison and weighted calculation. Using Azure OpenAI's ChatGPT-4, an AI generative tool, the project evaluates corporate engagement in sustainability issues and assigns a Green Identity Certification Index, ESG Index, as a reference for financial institutions in lending and borrowing. To continue this video, we are going to describe the preparatory techniques and methodology used in this project. The first step is screening of individual cases for green deposits and loans of financial institutions. Financial institutions must use green financial technology to provide green credit for eco-friendly projects like renewable energy and sustainable agriculture. The second step is establishing an evaluation mechanism to provide green identity certification to green deposit and loan objects. The following figure illustrates how this project uses prompt engineering to search for content containing specific keywords and runs it 10 times to ensure fairness. Factor scores are calculated by using the normal distribution cumulative distribution function. This plan is scored from 5 ESG aspects, including the following: emission of greenhouse gases, energy management, water resources management, hazardous waste management, and natural resources protection. Each factor has a score ranging from 0 to 5 to evaluate and compare the performance of different companies in these key ESG areas. Then, the third step is introducing the Green Identity Authentication Index to establish an enterprise green identity authentication mechanism. The Green Identity Authentication Index certifies small and medium-sized enterprises and nonprofits as green without carbon inventory disclosures. Verified by a third party, it integrates into the ESG index for credit evaluations. For the explanatory variable, we have the following: long-term average interest rate, short-term average interest rate, loan term, loan amount. The definitions of the control variables are company size, market-to-book ratio, debt ratio, earnings before interest and taxes, bankruptcy risk indicator, Z-score. This project uses vertical and horizontal regression models to assess how corporate SDG implementation affects bank loan contracts. Developed by Conker in 2004, these models handle longitudinal and cross-sectional data with random and fixed effects. The Hausman test determines the best effects for accurate regression estimates. The vertical and horizontal regression model settings of this study are as shown in equations.
Over the period from 2012 to 2022, by applying the panel data regression analysis, we observe that as the green banking performance increases, there is a significant positive impact on the implementation of SDGs goals by the companies. To test the robustness of these results, we apply quantile regression analysis. Specifically, we use quantile levels the 0.05, 0.1, 0.25, 0.5, 0.75, 0.9, 0.95 to explore the impact of green banking on different levels of SDGs implementation. Our findings indicate that at quantile 0.25, the impact of green banking on SDGs implementation is not significant. However, at quantile 0.75, and especially at the 0.9, the impact becomes significantly positive. Then, we are going to talk about method flow for the project divided in 9 months. For the first month, we arranged the project setup and literature review. The second and third month, we established the data gathering. The fourth and fifth month, we scheduled the data analysis. The sixth month, we arranged the drafting of the initial report. The seventh month, we established the review and revisions. The eighth month, we scheduled the dissemination. The ninth month, we arranged the project evaluation and closure.
The Sustainable Development Goals, SDGs, set by the United Nations, are increasingly guiding international efforts towards sustainable development, surpassing the influence of CSR and ESG frameworks. These goals are vital for promoting global economic growth, social justice, and environmental protection. A study utilizing data from the CSR-owned sustainability reporting platform evaluates companies based on their carbon emissions to measure their annual progress toward achieving the SDGs. Additionally, the study analyzes the impact of Taiwanese companies' adherence to the SDGs, excluding the financial sector, from 2012 to 2022 on their bank loan conditions, providing insight into how sustainability practices influence financial terms. This project integrates the Green Identity Certification mechanism to analyze the extent to which different industries implement energy conservation and carbon reduction measures, and the impact of these measures on the long-term and short-term financing costs, loan duration, and loan volume for businesses. The results of this project can assist the financial industry in developing a comprehensive solution for green deposits and loans, and allow financial technology operators and clients to create a collaborative platform that establishes a green identity certification mechanism. It is expected that the research results show that emission reductions have a greater impact on the return on equity, ROE, of shareholders, becoming significant 2 years after emission reductions and increasing in the third year, presumably because the cost-saving effects of emission reductions take a longer period of time to appear. Another expected result in the project is that when a company has a strong performance in CSR, it is more likely to obtain debt financing more easily. Banks are more willing to lend to companies with good CSR performance because they are perceived as lower risk. As a result, these companies can secure loans at lower interest rates and with reduced loan costs.
And here is our workforce breakdown. Thanks for your attention.